Hey, good evening, everyone, and welcome to today's live stream. My name is David, and thanks for tuning in to my live stream on YouTube, Facebook, and LinkedIn. Today, we're going to be talking about safe haven investing. And by the way, I hope you're all doing well, and I'm looking forward to giving you this presentation today. I actually think it's going to go by quicker than last Wednesday's 1 hour marathon session. Again, if you have any questions, please put your questions in the comments, whether you're watching this on Facebook, LinkedIn, or YouTube. And I'll be sure to get to your questions as we go through this on the fly. If you notice, if there's any audio issues, please let me know, and I'll go ahead and see if I can clear that up as quickly as possible. Tonight, I decided to talk about this because last Wednesday, when we're doing the live stream, I had a question come in by a frequent viewer of the live stream, and he was asking a question that I couldn't get to because we ended it just as I saw the question come in. But he was asking a question about, like, what do we do now? Because the last live stream, we're talking about recession proofing your investments, how to weather the storm, so to speak, of a recession that, if it was to come, sometimes those last 3 months or 8 months or even a year. So it's a different way to position your portfolio. But this is a little bit different right now. And this is the focus of tonight's session, is really going to be about what do you do if you are feeling uneasy about the market, and how do you position your portfolio in a short-term way in order to make sure that you feel comfortable and that you're not losing any ground. So that's really what the focus of this session is about, is what are you going to do over the next 3 to 6 months, hyper focused on how to put your portfolio together. So if you have any questions, put them in the comments below. Okay, so why don't we get right into this right now? And again, thanks for tuning in to the channel, and we're going to dive straight into this, and I'll answer your questions on the fly, okay? All right, so let's look at the, oh, by the way, if you're new to the channel, please subscribe to the channel, hit that bell so you're notified of any new videos, and I love seeing new subscribers. I'm saying that because we're so close to 1,000 subscribers, so I'm really stoked about getting that, and thank you for all your support. Okay, so let's move on to the first one. This might be you. If you're worried about market volatility, this is going to be a session for you, because we're focusing in on what do you do in a 3 to 6 month range. This also might be for someone who is in that retirement zone, that 10-year zone of that 5 years before retirement and the first 5 years of retirement. This is really where you want to mitigate any severe downturns, any severe negative returns in the marketplace, because in the first year or two of retirement, if you have a severe downturn or negative return in your portfolio, it will severely impact the balance of your portfolio, because you're withdrawing funds at the same time. So it actually impacts how long your money will last if you have a severe negative return in the first couple of years versus having a severe negative return later on in retirement. Now, this is a recent survey that was done. Over the next 9 months, nearly every brokerage firm and bank sees positive returns in the market. So this isn't really about what's going to happen in the fall through to, let's say, the beginning of 2023. This is really about what's happening over the next 3 months. How do we position our portfolio in the short period of time of a 3 to 6 month range? Let me make sure I can get to, there you go. How do you position your portfolio in a way that mitigates this very narrow window of uneasiness in the markets? And I was trying to think of an analogy today to help people understand what's happening in the markets. And the way that I thought is, I hope you can appreciate this. And that is, think about the relationship of weather and the markets. When we move from winter to spring, there's always that 1 month. And this year it seems to have been the end of March, where it can't decide whether it wants to snow, rain, or get warm, get cold, whether it wants to blow strong or not, or all of the above. Those days where we've had rain, snow, and sun in the same day. This is similar to what's happening in the marketplace, because as the Federal Reserve in the United States and in Canada, as they raise interest rates, the market needs to try to understand how to work, how to retool our investments as we go into this increase. Hi, Ivan, I'll get to your question, and thanks for tuning in today. The market has to make an adjustment, and it's not just an adjustment on a little bit of interest rate hikes. We're probably going to see at least 1% before the year is over, maybe even higher of increase. And so that's a pretty dramatic increase in rates when we've seen next to zero for such a long time. So what's happening is very much like the weather. It's trying to figure out where is the balance here? Where's the right balance? And like the weather, it tends to find its way to out of the stormy weather and into clear skies. And so that's what I want you to kind of put your head around, or put your head into that space, is that this is a very short period of time where we're going to have some painful returns. So anyone that's panicking right now, you could position your portfolio in a defensive way, which I'm going to get into right now. Okay. All right. So let's dig into these slides, and I hope you can appreciate what's going on. What I think that's going to happen in the next month or two is that investors are going to see that they've made quite a bit of money over the last year, not just the last year, but they're going to see that they made a lot of money. And this first 3 months of the year was very painful. And so that's what we've been seeing, actually. We've been seeing people taking their profits, especially in the NASDAQ and technology stocks, where they've made such a lot of increase in their portfolios, that they're going to take their profits and they might adopt a more defensive position throughout the summer. It's not that they're getting completely out of the market. They're just saying, you know what, I'm going to just take some profit off the table, and I'm going to be more defensive. And here is a good illustration at the 1 year return of the Dow Jones, the S&P 500, the NASDAQ, and the S&P TSX. You can see how it ran up quite strongly in the last year of even having COVID and working through all of the problems we did. And then from about, I guess, January, basically January 1st, somebody rang a bell and said, okay, get out of the NASDAQ. And the market sold off pretty severely. And so that's why I think people are taking money off the table right now. And that's why we see a lot of negative days. But today's reaction to the market is different. The Federal Reserve in the United States released some of their minutes, that's notes, right? That's corporate talk for notes of meetings that they were having around what are they going to do for interest rate hikes. And the Federal Reserve have basically told us in advance they're looking to raise rates by 50 basis points in the next meeting. So that put a huge scare into the market. The market began to go negative. It's not a bad thing. It's just people were wondering along the way, what is it going to be, a 0.25% point? Is it going to be a 0.5%? Now we have some pretty solid evidence that it might be a 0.5 percentage point. And that's kind of why you're here today, right? Because you just had 3 months of negative returns. We had 1 week where we were up 4 days and then down 2 days. And so people are like, what do I do? How do I don't like what I'm seeing in my portfolio. I don't see any end to it. So how do I change what I'm doing in order to feel better? And it's really about rethinking your investment strategy over the next 3 to 6 months. That's all that it is. It's not changing your entire outlook, just over the next three to 6 months. Now, the safest asset in the world is the US 10-year Treasury. Now, you wouldn't know that when you look at this performance over the last 15, 17 years, that this has actually been going down and down and down. But I guess the reality of this is that if somebody got ultra scared, like really, really bad, and just put their money in US 10-year Treasury notes, they would have made money, but it would have likely been, you can see, well below inflation. In fact, that 2.54, that was the ending rate for today's date. That's still well below inflation, 7% in the US and 5% in Canada. But nonetheless, it's the safest place. But if you're thinking about that and you go, okay, so when people believe there's an increased risk of crisis or recession, they shift their money into bonds. And so you as an investor go, well, where do I go if I'm thinking about bonds? Let me get out of the picture here because I want it just to be, there we go. And you look at fixed income and it's just been negative returns through for the first 3 months of the year. So you go, okay, now what do I do? I'm putting my money, I'm trying to get out of the S&P TSX, or sorry, the S&P 500, out of the NASDAQ, not completely out, but get away from these negative returns. And I go to fixed income and it's only negative there. So what am I supposed to do? So I had this on the last slide, and I think I'm going to say it. I won't spend a lot of time on it. But the first thing you ought to do is review your risk tolerance. If you are someone who is really uneasy about the markets right now, chances are you might have your portfolio invested in maybe too much equities right now. And you're a little bit in an area where you're not comfortable with the volatility. And that's because you're well past probably a balanced investor in terms of the allocation. So it's when you change the allocation of your portfolio, it's not a permanent thing. You can change your allocation as much as you like. So for the next 3 to 6 months, if you're feeling uneasy, be a little bit more conservative with your money. Go into a more conservative defensive position. I'm going to show you exactly how to do that. And that way you don't have to be so nervous about the markets. Okay. So let's have one suggestion. You're going to increase your Canadian allocation. Now I say this, and the reason for that is because throughout last year and the last 2 years, when COVID hit, the biggest advancement that we saw in the markets was in the US market. The market was on fire, especially the NASDAQ. So having some of your money in US equities, specifically technology, was a very advantageous place to be because you made a lot of money. But right now it's not. From the beginning of January of 2022, it has not been a good place. So it's time to shift your money away from perhaps Canada or US and move more of the allocation towards Canadian allocation. And here's why. I had this on the last, and so I hope you can appreciate the last live stream. Canada is very small. You see that in the bottom left-hand corner around 7 o'clock. Canada makes up about 2% of the world's GDP. And so if you're looking for a place to hide, well, you're going to avoid 98% of the world's problems if you invest only in Canada, which is not a bad thing to do right now. And I just want to just stop for a second and just say one thing. If you're not nervous about the market right now and you can handle volatility, then everything I'm saying, throw it out the window, because it's incredible opportunities for you. Because as markets have volatility, the very securities that you're looking to invest in are lower. And so it's a time for you to add money to those investments. So there's two trains of thought. We're only focusing on the person who is uneasy about the markets right now. So I just want to be clear that I'm not giving flat out advice, get out of the US. I'm talking about the person who is uneasy about the markets and how to make yourself a little bit less uneasy about that. And so you look at this, positive returns in Canada. This is the year-to-date returns for the S&P TSX, the S&P 500, the NASDAQ, and the Dow Jones. Look at the US markets. They're all negative returns. I have to get closer to the screen here. The NASDAQ is minus 10%, the S&P 500 about minus 6%, and the Dow Jones is about minus 5%. But the Canadian market is close to 3% positive. So there is evidence over the last 3 months that if you were a really kind of uneasy about the markets and looking for like flight to safety, then Canada obviously is the biggest choice there. But if you were an investor who was just looking for the right time to get into US markets, well, it's been over the last 3 months, hasn't it? In fact, it was closer to the end of March where the NASDAQ hit the bottom. So that's where you would have wanted to get in, but that's market timing, hard to do. And then if you look at what's the next thing to do is you want to look at investments that produce dividends. Well, what kind of investments produce dividends? Those are investments that you see every day. So think of this as a defensive stock or fund that provides consistent dividends and stable earnings regardless of the state of overall markets. And I like to do this in every session. So does anybody want to put a comment there of where you think you might see, what kind of companies might have stable cash flows or stable revenues, and that will always, I'm giving it away here, but it will always give you a dividend, and rarely, if ever, will cut their dividend. Anybody want to venture a guess? Put it in the comments, and I'll be happy to have to feature you in the video. I'll just wait a couple seconds here. So the answer to that is, you got it, Rosemary. Nice to see you on the call. I said I would show it. So Rosemary, here you go. I'm going to feature Rosemary gets the top prize, bank. Yeah. So that's exactly right. If you're looking to invest your money, here's where you could put your money to get into some defensive positions. Okay. So the first place is, well, not first place, but I'll just put this up here, commodities. If you're thinking about, it's a good place to have part of your investment is going to be in gold, silver, copper, anything that is going to be like this in the case of corn. These are steel materials. These are, no matter what the economy is doing, corn makes up quite a bit of the additives that are put in fuel now. It's why corn is so expensive, because it's no longer really something we eat. It's something we actually burn in our cars. So no matter what happens, these kinds of investments are a safe haven. That's the purpose of tonight's video, safe haven. So if you were to put anywhere between 15 to 30% of your money in these types of investments right now, you would be well served in that kind of investment. Now, the next, of course, I ran through these. I'm going to take my picture out of the way on the next, on the last video we did, but I think it's worth revisiting a little bit more detail. You can see you've got the Canadian maple leaf there. So what I'm really saying is, over the next 3 to 6 months, heavy weighted in Canada. So you'll hear it, overweighted in Canada, which, when you say overweight, means how much of your portfolio is allocated to Canadian investments, US investments, European, emerging markets. I'm saying try to be overweight in Canada. This is a good place for you to hide while the markets are trying to adjust to raising interest rates, while the market is trying to adjust to wars like in Ukraine and Russia. This is a good place to go. So the first place, Rosemary is right. Financials, banks tend to do well no matter what happens. If it's in a good economy and a poor economy, banks, people are still paying their mortgages. People are still borrowing money to because they need to buy new cars. Car leases come up. Their financing needs to be restructured in some of the things for businesses, for business owners. Banks are always going to be making money. And so that's one area where you want to put your money. The other thing is the dividends, right? So banks, typically the old British system of managing companies, is the shareholder is the most important person. And so they really want to make sure that they don't decrease their dividend. They want to always be increasing their dividend. So that's, again, that area of where you want to be is investing in financials. Consumer staples. This is super easy. I just want you to think toilet paper, tissue paper, washing your body, consumer staples, right? Shampoo, groceries. These are things that people need to do every single day, no matter what happens. They got to feed themselves. They got to keep clean. They got to wash their babies. They got to take their medicine. So those are the areas that you want to focus in. And when I say these things to you, I want you to pay attention to, when you look at fund prospectus and it says where does this fund invest money, it says it right on the fund where the sectors of this, where this fund is being invested. And that's why I'm giving you these names, because I want you to see them specifically on those funds that you're looking at. Energy. Typically during high interest rates, that actually pushes up energy. And certainly during times of political, geographical disputes and conflicts and wars, that pushes up oil prices as well. And so we're seeing that right now. Utilities, people need to keep their heat on, their electricity, the lights on in their home, their air conditioning running throughout the summer. They need to keep their water running in their house. So these are the things that people must do. They got to eat, they got to clean, they have to have electricity and water. So during times of economic pressure, we'll call it, those companies tend to do well. And the last one I have is real estate. The real estate, when we're talking about real estate, this means two things. One could be REITs, real estate investment trusts that you can invest in. And the second is actual real estate, rental properties, owning rental properties. Even though the economy might tighten, or even though interest rates are going up, I don't suspect we're going to see, in rising interest rates, I don't suspect that we're going to see a real massive problem in the housing market, not right now, over the next year. I see that as a problem in about maybe a year and a half to 2 years, but not right now. And so people still need housing. They still need to live. And so people are going to rent. But most specifically with real estate investment trusts, if anyone is investing in those, you want to stay away from high-end luxury buildings or residential buildings, because this is a problem, right? If you're going to have a downturn in the economy, people are going to be looking for affordable places to live, not luxurious places to live. And that's one thing you want to keep in mind, okay? Back to this slide. And, an office. If there is, when we're coming out of, see, the whole point to the raising the interest rates is trying to avoid a colossal failure, trying to avoid this recession that everyone believes we're likely going to have in 2023. And they call it a soft landing, right? So they're trying to adjust interest rates so that we can tamp down inflation and slide into a decent economy, not so robust, but a decent economy a year from now. And the problem is that we've had, I'm not going to get into a lot of detail in this, but we've had an inversion in our yield curve, which tends to suggest that around 7 to 24 months from that point, we have always gone into a recession. And out of the since 1956, every time we've had an inversion in our yield curve, between 7 to 24 months later, we went into a recession. And so we've hit that mark. So that's why I believed we're going to go into a recession next year. So between the next 3 to 6 months, be defensive, reposition your portfolio after that to have a moderate, so meaning in the fall, have a moderate return, single digit returns, what I'm thinking at least, maybe 8-9%. And then be prepared at some point in 2023 to begin entering into recession. So that's my thinking behind that. Okay, my crystal ball is on the table, right? Let's go back into the slide to make sure we haven't missed anything. Yeah, we haven't. I'm glad that we got through that. Okay, guys, that's all I've got for you today. Look at that. I did it in half an hour. If you have any questions at all, put them in there right now, because I'd be happy to hear back what you think, or if you're worried about anything, let me know and I'll speak specifically to that right now. But that is my sort of feeling on what you ought to be doing with your portfolio. Now, I'm an active advisor. I manage people's investment portfolios. I also use life insurance, and I help business owners and individuals and families. So I'm actively switching my own clients' portfolios allocation to be slightly more defensive over the next 3 to 6 months. Now, for anybody that is retiring or going into retirement, that makes sense. But for anybody that is, 50 something years of age and you're still working and you're still pounding away at your portfolio trying to invest in it, it's not as critical for you to do that, because it's not going to impact you greatly. But it doesn't mean you just can accept negative returns. If you can mitigate that, that's good thing to do, good practice to do. So that's kind of my thinking. So it's what I'm doing right now with my own client portfolios, and to help them sort of feel a little bit less overwhelmed with the news that's going on. Well, I don't see any questions coming in right now, so I'm going to say thanks very much for tuning in today. I appreciate you you following me again and tuning into my live stream. I always try to end my live stream saying that we take care of your wealth management so you can take care of what's most important to you. There's my contact information. I look forward to seeing you next Wednesday. Just making sure the calendar. Next Wednesday, we'll be doing a live stream again at 7 o'clock. If you have any video suggestions, please let me know. Put them in comments. Please follow the channels and share this information with anybody you think needs to see this so they feel much better about what they ought to be doing. If you have any questions about your portfolio, please feel welcome to contact me. I'm happy to answer your questions, give you a complimentary portfolio review, if anything, just to reassure you that what you're doing is the right place for you to be over the next few months. Richard, hey Richard, thanks for tuning in. Richard's first time tuning in to this live stream. I hope it's not your last. And Richard, you'll find all of my YouTube videos, all these videos on YouTube. Okay, guys, that's it for tonight. Thanks very much for tuning in. Everybody be safe and be well, and I'll see you next Wednesday. All right, take care. Bye-bye.